Hey guys, John Polemy here, Actionable Intelligence. Today is Sunday, June 28th, 2020, and this is the weekly market update. So in this week's reality check, I wanted to go back to the discussion that I started last week a little bit and kind of visualize why I think hard assets, gold, digital currencies are going to do extremely well over the next decade. And I think this chart from the St. Louis Fed, their Fred website, that's where they have you can go there and get all these graphs. You can look up any kind of economic statistic and get it in a graph form. But basically what I've done here is I've went there and I've put two data sets on here. One being in blue is the gross domestic product for the United States going back to like 1940s somewhere. And in red is the total amount of debt for all sectors, government, private sector, personal. And what you can see is around 1980, but actually prior to that, if you go back and expand this thing out, you will note that debt and GDP pretty much tracked together during the time when we had hard money, when we were on a gold standard. As we've talked about before, in 1971, you can go look up the YouTube video where Nixon takes the United States off the gold standard. That was back here in 1971. And you can see that we've had a tremendous amount of debt growth relative to our GDP since. So I'm not going to get into the merits or the discussions of the gold standard, pluses, minuses, pros, cons, if we'll ever go back on one. All these things, it's immaterial. What's material and what matters is what's happening. And you see this alligator jaw wide open here where you have a tremendous amount of debt. And now with the coronavirus quasi-depression that we have, with the response from the federal government, with the prospects of running multi-trillion-dollar deficits, and with a contracting gross domestic product, we're in a bad spot. I mean, ultimately, it's a mathematics problem. We have, the interest on the debt, it goes back to this. Your cash flows from your economy will not be able to support the interest payments on your debt. Now, this is debt of all levels, not just government. This is student debt. This is personal debt. This is auto loans. This is the whole shebang. And the bottom line is the cash flows from the gross domestic product cannot and will not be able to support just the interest payments. Forget about paying the debt off. So I wanted to point that out. So where does that take us? Why am I thinking about this? Well, it's not going to get paid back. We are now in a mess here of our own creation over many, many decades now. It's now been brought to the head by the overreaction to the COVID-19 crisis. And now we're talking about going into more lockdowns because of the resurgence, supposedly, of cases. Now, I'm not going to get into that. You can have your own views on that. The fact remains is that they were wheeling out all the big guns last week in the Trump administration to talk about the V-shaped recovery we're supposedly in. We're not in a V-shaped recovery. This is a mess, and I don't know how we're going to get out of it. But the fact remains is what is happening is that we need to understand how this plays out or what we think will happen, and then what are the repercussions from that, and then how do we position ourselves. And I would say, right now we have the treasuries issuing tremendous amounts of debt. They're backstopping the economy, all these programs we've went over it ad nauseum. Everybody knows about it. But who's buying all this debt? We know foreigners aren't doing it because foreign purchases of debt have been down for several years because of our, shall we say, over-the-top foreign policy and our way of just the geopolitical situation in the world. We're a declining power. China is a rising power. There's a lot of things playing into that. Suffice to say, we are not having a lot of take-up of our debt around the world. As a matter of fact, Russia's almost divested itself, if it has not, of all of our debt holdings that it was holding and replaced it in many cases with gold. So who's the buyer of last resort? Well, the Fed is. Jay Powell said that the Fed will do whatever is necessary. That's what he said. We talked about that last week. But where does the Fed get the money? The Fed doesn't have any money. They have keystrokes on a computer, or they can print money, physical currency units. So they will monetize the debt. The other thing that they will do is that they will cause interest rates to be suppressed as much as they can. Why? Because if interest rates were allowed to reach their real value, you would have the country would go into a deflationary collapse. Interest rates would go through the roof because the credit risks and all the other things. But what's the Fed doing? It's not just buying government debt, it's buying corporate junk bonds. We talked about that last week. And as this thing gets worse, the calls to do more are going to be there. And the Fed said they would do more. They would do whatever's necessary. Now we're in an election year. We have, I'm not saying that Trump is some physical conservative, but some of the ideas of some of the people that may come into power are even more aggressive on the debt and monetary front than what we're experiencing now. That's a definite risk. We talked about the Stephanie Kelton book, that Deficits Don't Matter, which I'm finishing up, and we'll have something to say about it in the coming weeks. But there's a lot of people that don't have a good education on this, and they think that, well, all this largesse goes to big corporations and to the Sharpies on Wall Street, which it does. It's a rigged game. And so we want ours. Pay for my college. Pay for my health care. Give me a guaranteed government job with a guaranteed wage. These are ideas that are getting more and more traction. And you can sit back as an old fuddy-duddy. I was watching a video on Twitter this morning, and a guy was on his front porch, and there's this old man. He must have been like super old. He was going for his morning walk and on the sidewalk, and the guy was on his porch filming the guy. And the guy, as he approached the guy's yard, the guy had an American flag on a flagpole. And as this guy approached it, this old guy, he must have been in his 80s. He seemed very old. He stopped, looked at the flag, and saluted it and kept walking. So the guy on Twitter says, "This is the real America." And he's right. It is the real America. But the real America is dying. It's being replaced by a new America of younger people that are skew left, that skew as foreign-born, or the children of foreign-born, who are not steeped in physical conservatism or Jeffersonian democracy. They come from places where there's a paternalistic attitude that's looked at into corporations and governments. They, this idea that everybody's just going to come here and that's not it. Things are changing. The old way is dying off and the new is coming. Can't you see it? People are just dismissing this. I wouldn't dismiss it. The millennials and the younger people, they skew towards socialism. They don't really know what it is, but they want theirs. They're not advancing in life. Their life isn't starting. Now, we can get into why that is, or that you can just go out and make your own way. I'm just telling you this is going to be reflected in politics, and politics is going to have a reflection on the economics and government policy of this country over the next decade. You just saw Democratic primaries that happened in the last week, where old line Democrats, I forget the one guy's name up in New York. I mean, he was on the House Foreign Relations Committee. He was the chairman. He's out. He's been in Congress for 40 years. He's out. A progressive is going to get his seat. So what I'm trying to tell you is that we're going to go into the direction of more of this, not less. The hope, I think, of a lot of policymakers currently is that we'll throw the kitchen sink at this monetarily and physically, and then we'll have a V-shaped recovery, and we'll get back to some type of normalcy, and then we can deal with it later. Because right now, it's like I said before, if you're driving to the hospital for your cancer surgery and you get in an accident and you have an arterial bleed in your leg as a consequence of the car accident, the first thing that the EMTs are going to do is deal with the arterial bleeding. They're not going to worry about your stage 4, pancreatic cancer. that you were on the way to the hospital for surgery. And that's kind of the analogy here, right? I mean, we're bleeding out, so they're throwing the kitchen sink at this, and then nobody's worrying about what's going to happen a year, 5 years, or 10 years from now. So what's the repercussions of all this? At some point, the market's going to wake up. I mean, it happens. I mean, you saw it happen in the stock market in February and March. I mean, we had coronavirus cases were growing all over the world. People were flying into this country. It was a matter of time till it got here. We made all-time highs in the stock market in February, and then we finally realized what was going to happen here, and all of a sudden it just fell out of bed. I mean, everything seems fine until it's not fine. Everything's fine in these markets until it's not. Then there's a readjustment. So what I would suggest is going to happen is, if these deficits keep running at these high levels and the monetization of the debt continues, at some point, doesn't this have a negative influence on the U.S. dollar? If you just keep printing more and more currency units, if you don't deal with the long-term cancer that you have, which is too much debt, what happens when the market does wake up to it? The U.S. dollar is a confidence game. The reason it has value, the reason it has the stature that it has is because we have not overinflated it. Have they been messing around with it? Yes. You can see they've had to since, for the last 2 generations. But before that, we're living on the inertia and the reputation that was, earned back here, not here. And I'm telling you, things are changing in the West and in this country. And they're going to be more progressive. There's going to be new ideas that are not monetarily sound, in my view, and are not market sound. So if this isn't halted, at this point, it can't be. You can't just stop printing money. You just can't stop doing what we talked about, crossing the Rubicon. We're past that point. It's like in Weimar, Germany, or these other places. Once you start printing to hold up markets and to hold off the reckoning, you can't ever stop. Because if you do, the whole thing implodes. The whole thing comes down. It's like a bouncy castle, right? You have that little motor that's pumping that air in, right? And if you shut the power off, the whole bouncy castle just deflates. That's what this is similar to. And the problem is with the amount of debt we have, you have to print and create and monetize and inject and do more interventions at higher and higher levels at ever expanding rates just to keep things from not imploding. How is that positive long term for the dollar or for the economy or for this what we're seeing? Now the retort will be, well, John, the stock market's making all-time highs. Yes, printed money goes into the stock market. We could conceivably have economic dislocation and an increasing stock market because people put money, they have to put it somewhere. I think, though, over the next decade, where you're going to see a lot of money move to is into hard assets. People are going to start realizing what's happening. They already are. That's why gold is up in just about making new highs in just about every currency around the world except for the U.S. dollar, which it continues to creep higher. We're 1770 this week, I think we hit, 1780, something like that. And I think digital currencies, that there's going to be a movement towards that. I mean, people can see what's happening, and the amount of people that can see it is growing. So I see the alternatives as being gold, digital currencies, and commodities. And commodities not from a demand perspective. You've had a tremendous amount of supply destruction. As prices have went down, marginal producers go out of business because of COVID, because of other dislocations. Supply is taken out. So your demand for a certain commodity can go down a certain percentage, but the supply goes down even further, you could still have price increases. And then if you're adding all this monetary inflation, if you're throwing more currency units at the same amount of goods or less goods, the prices of goods will go up. So that's my thesis there. That's where I think we're going. So a couple pieces of information came out this week. The BP annual energy review. It's pretty good. Here's just a chart from that. It's nuclear electricity generation from selected countries. This, of course, the top line is the United States. This country right here is France. This is Japan. You can see the drop off after Fukushima. It's kind of slowly coming back. But look at this. This is China. China in the next year or two will supplement France as the second largest producer of nuclear power in the world. And when you're talking about nuclear power and nuclear power demand and growth, that's where you have to look. In emerging markets, places like China, India, okay, that's where the growth is. Forget about the West. The West is in decline. Okay, we may build 1 or 2 reactors here or there. We may extend the life of a few reactors. You know, I've been a big advocate for growing the nuclear fleet. Until I see that any change, it's just not. It doesn't seem to like it's going to happen. But it may. Things can change. I put this little, let's split atoms, not birds. But until we get over this narcissistic view in the West and start looking at facts and not just what we want to happen, we are going to continue to ignore nuclear as a fix for a lot of our energy problems and a lot of our emission problems. So I wanted to pull this out of another presentation I saw. This was taken from the World Nuclear Association source, but somebody put the graph together on Twitter. Here's your estimated primary and secondary production for 2020 in millions of pounds, slightly over 150 million pounds. Here's the demand on this side, 450 reactors in operation that are demand well over that amount, close to 195 to 200 million pounds. So you already have a built-in deficit that's been made up by secondary supply and inventory reduction. Then you have the 54 reactors under construction. That adds another, 25 million or pounds of demand. Then you have the 111 reactors that are planned. Now you're up to, 275 million pounds of demand. And if you take the proposed reactors that are going to be built over the next 10 or 20 years, you're talking about, demand being 400 million pounds on a current primary and secondary production being 150. So what I'm trying to tell you is that, the narrative is still there. I don't talk about it that much anymore because what's there more to talk about? I mean, there's those little nuances here and there. And, you got to be careful, guys. I've said this before. And that's why a lot of people like excitement. They like their ears tickled. They want to talk about that junior miner that's out there, working on that old Union Carbide mine somewhere. I'm not interested in that. If you are a serious person that gets this and understands the long-term situation, there's only probably one mining company that's worth investing in right now. That's Kazatomprom, which you'd have to buy on the London Exchange. Most people shouldn't be messing around with these juniors. They're just speculations. Most of them will never produce a pound of uranium. And all they do is incinerate cash. I've been saying that for a year and a half. Kazatomprom pays a dividend. I mean, or buy, like I said, physical uranium when it's selling at a discount to net asset value. That's what you should be doing. And then when this thing really takes off, and it will, it's not going to get away from you, just pay attention, then you should be buying select juniors. Okay? Or companies that can come into production fairly quickly. You know who you are. But messing around with a lot of these juniors that keep deluding you and keep selling the same story they've been selling for, since the last, we all know about the one active or potentially active uranium mill in the United States. When is it going to produce some actual uranium at a profit? You have to ask yourself those questions. But they continue to sell more stock. So if this uranium price boom comes in 3 to 5 years, what's the share count going to be at some of these companies? They'll just keep issuing shares and they'll just do a 1-for-10 reverse split. Then they start over again. You really have to understand what you're involved in. Do you? So that's my view. The story is good, but there's not that many companies that are investable, and the rest are pure speculations. Now, if you're nimble enough to jump in and out, that's good. I'm looking at things that are either in production at a profit or can come back into production fairly quickly, that can catch a price rise and actually get into production and produce cash flows. That's what I'm interested in talking about. World Nuclear Report came out this week. I just wanted to touch on part of it here. These are some excerpts right around the demand situation, why nuclear power is growing around the world. Four data points. In France, the country's energy policy was modified, delaying the timeline of planned reduction of nuclear power and the share of its electricity mix to 50% from the previous 2025 to 2035, and allowing operating lifetime extensions of existing reactors beyond 40 years. It's very important because you have a lot of countries wanting to shut their reactors down, like in Germany. Germany imports nuclear baseload power as a way to stabilize its grid. In the USA, state legislatures are starting to pass measures that support the continued operation of reactors, recognizing the valuable role of nuclear in providing low-carbon electricity. At the same time, the process of granting a second operating license extension for U.S. nuclear reactors has begun, allowing reactors to operate for 80 years. I actually saw a article, it was in an engineering publication or maybe Power Magazine, where they have new metallurgy for the reactor vessels that will now allow them to operate for upwards of 120 years. So there are technological advances. The industry continues to innovate and get better, and it will continue to, because nuclear is the safest, best, most efficient way to generate baseload power. So here's the key right here. Both China and India have extensive nuclear expansion programs. The reference scenario projects nuclear generation capacity in India to grow more than 6 times from the current level. And China is expected to reach almost 179 gigawatts in the reference scenario, quadrupling its current nuclear capacity. Quadrupling its current nuclear capacity. That's what I'm talking about here. That's what's going on. Now, it's not going to happen in the next year or two, but it's a long-term trend. It's in place. It's going to happen. The Chinese in the current 5-year plan have reiterated their intent to build 6 to 8 reactors a year ad infinitum. The prospects for new reactors in many countries have improved, with several newcomer countries launching construction projects, i.e. Turkey, Bangladesh, Egypt, and several more demonstrating a clear interest in developing nuclear programs. Uzbekistan, who just happens to be a very large miner of uranium, Kazakhstan, and Poland. Matter of fact, Uzbekistan is one of my favorite emerging frontier markets. It's tremendous potential over the next 10 years there. Not just in uranium, but just overall. Here's an article. I'll put a link to it in the show notes. Mike Schellenberger writes on nuclear. He's an environmental guy. He used to be an activist. I don't know if he still considers himself an activist. He's coming out with a new book, but the title of this article that he put up was pretty good, I thought. And it says, why climate activists will go nuclear or go extinct. Here's a couple quotes from the article linked in the show notes. He says, for the last decade, I've been obsessed with the question, why are the people who are the most alarmist about environmental issues also opposed to all of the obvious solutions? In nearly every situation around the world, support for nuclear energy from climate activists like Thunberg and AOC would make the difference between nuclear plants staying open or closing and being built or not being built. And then he goes on to ask, why aren't they getting behind it? And it's because the main problem facing nuclear energy is that it's unpopular, and far more among progressives than conservatives, and far more among women than men. And I think the article is good because it goes on to talk about an exchange that Mike had with a activist from Extinction Rebellion, where he was able to show the facts, and this person actually changed their mind on nuclear power and has now become an advocate for nuclear power as a way to deal with the perceived climate crisis. So I guess what I'm saying is there's hope. I'm basically relying my thesis on the growth in the emerging markets in China and India to drive demand, because they're not going to stop for anything. They have tremendous growth in electricity demand. They will make nuclear power the cornerstone of their baseload generation scenarios going forward. Now, I want to talk about a contrarian speculation. This is a speculation. I'm going to throw out a name. This has been all over Twitter. If you don't know about this name, it's been all over Twitter. But I just want to get real quick into the natural gas situation potential. And what we've seen is a tremendous amount of financial distress in both oil and natural gas producers. We've talked about that, especially in the shale plays. We've seen a tremendous push towards shareholder returns, i.e. dividends and share buybacks, debt reduction. That means the era of unlimited capital and unlimited drilling for the sake of drilling may have come to an end. But anything's possible in a Project Zimbabwe type environment that we find ourselves with the Fed creating money and buying junk bonds. But currently, what we're seeing in these industries, specifically in natural gas, is lower capital expenditures, which have been announced across the board, leads to lower rig counts, less rigs drilling, equals lower production, equals higher prices. And this is from this quote is from a research paper that I will put a link to that's pretty good. It goes through, it's about 40 pages, but if you want to know the background of why, it gives a pretty good outline. I mean, basically, you can just follow, and I'll show a chart in the next slide, follow the rig counts because production follows rig counts. And natural gas decline rates are far greater than what you see in the oil fields. So anyways, rig counts and capital spending can move around quickly. This is true. I mean, as prices go up and down, rig counts can come back quickly. But regardless, our analysis highlights the dramatic impact that capex levels have on natural gas production. And when supply in a commodity is pinched without an equally sized offset in demand, it usually leads to one thing: higher prices. I mean, I'm speculating with Antero Resources. It's not in my newsletter. I'm just putting this out here. I'm not recommending it. I'm just saying you may want to take a look at it. You can go on Twitter. There's plenty of smart people that have analyzed this. But basically, here's the scenario for the visually here. Here's your 6 months advanced rig count. So here's your rig counts, and you see that as you increase the rig count, production goes up. And as rig counts now are rolling over, you will see, and this is in Appalachia and Haynesville natural gas production, and they advance the rig count by 6 months. But anyways, what you're seeing here is, obviously, if you have less rigs drilling, production is going to follow it down, right? And the rig count has collapsed for we're at total oil and gas rigs turning in the U.S. are at levels we haven't seen 1940. So we haven't seen this many rigs, this few amount of rigs drilling since 1940 in the United States. That is going to have an impact on oil and natural gas production. The question is demand going to fall faster so that you continue to have a surplus? I don't think so. I mean, demand has pulled back because of coronavirus. We may be looking at a second wave, but supply, if it falls faster than demand, we will have a price reaction. Now, the good thing I like about Antero is that it had a big run already. I mean, this is a very popular stock. They did a few things financially. A lot of people thought this company might go bankrupt. They were able to make some moves and get themselves out of that situation. They have all of their production for 2020 is hedged at, I think, around $2.50 a thousand cubic feet. So basically, their cash flow is pretty certain for this year. They've really pulled back on capex, but I think that 2021 could be the year that we see a big move in natural gas prices. And I would suggest following rig counts. And if the rig count continues down or levels out at a low level, which it could, this is very easily, if prices go up, it could very easily spike back up, right? And then production would follow. But that's why it's a speculation. I just don't think the desire, the intent, the willingness to throw more money at this is there on Wall Street or in the banking system. It just, or investors. And why? I mean, here's what we got. This is from a article on Bloomberg. Burn, baby, burn. This is showing you free cash flow, all negative for the history. I mean, this whole shale thing has been a disaster. U.S. shale oil and gas producers have burned through $342 billion since 2010. They have never had a year of positive cash flow in total. Now, there's been individual companies that have, yes, but in total, this has been nothing but a big misallocation of capital enabled by low interest rates caused by the Federal Reserve keeping interest rates artificially low, which has caused investors to go look for higher yield securities, i.e. junk bonds, and that's what funded a lot of this. And I just don't think it's going to be there. I mean, people have been burned too many times. Maybe they haven't. Like I said, we are in a Project Zimbabwe situation where the Federal Reserve has said they're going to print any amount of money and buy junk bonds. Maybe they're going to go out and continue to buy these crappy bonds of these crappy companies that don't cash flow and enable another big run to the upside for drilling. But maybe, again, they won't. That's the speculation. That's why you have to watch. If you want to get involved with this, it's all going to be about rig counts. If the rig counts stay down, production is going to fall off a cliff. And we will have another winter eventually. If we have a bad winter and our production has went off a cliff and supply is crashing, that's a potential opportunity. Now, that's a lot of plates in the air, I understand, for the average person listening to this. But that's what I'm saying. And some of these things could go, triple, up 5 times, up 10 times, some of these companies in a situation like that. That's the game that I play. So, just wanted to throw this out there as a speculation. Been a lot of discussion about it. It's pulled back recently because of the new COVID lockdowns. Everybody's where we're going to lock the country down again and we're going to have another crash in demand. And I don't think that's going to happen, but we'll see. But if the supply crashes, if we're at rigs turning at 1940 levels, our economy is many, many times larger than it was in 1940. The demand is very much higher, even if it's suppressed a little bit by this coronavirus. These things don't turn on a dime. So something to look at. All right, guys, that's it for this week. Appreciate the following. Continue to get new followers, well over 4,000 now, subscribers. Appreciate it. Please subscribe. Please pass this on. If you are interested, I really think this is going to be a tremendous decade for people that think that hard assets are going to be the place to be. That's mostly what I focus on in the Actionable Intelligence newsletter. Not only that, but emerging and frontier markets. I think there's going to be tremendous opportunity there. A lot of people don't agree with me. They think things are going to be wonderful and everything's going to come back and be great. I don't think that. I think we're going to have a lot of turmoil in the West going forward. I believe we are in the fourth turning, and I think that you have to be very nimble and your thoughts have to be well outside the box. If you think everything that applied for the last 20 years is going to apply going forward, I think you're going to wake up and be severely disappointed. So that's where we're going. We think that that's where the opportunities are. So if you're interested in that, I have raised the prices because we've had tremendous demand. Our returns are looking good. We're looking at a lot of gold stocks, junior miners that are tremendously undervalued. And looking at that gold price, when that thing makes new highs and cracks $2,000 an ounce, I think there's going to be a huge shift of money into the gold mining sector. So if you're interested, think about taking a subscription. But like I said, if you want to help us out, just subscribe and comment. And we look forward to talking with you in the comment section. That's it for this week, guys. Take it easy. We'll talk to you next week.